Listen to this.
Might result in some very good buying opportunities. As he recently said, now with unimaginable risks on the table, it's appropriate to sniff out for bargains. The babies that are being thrown out with the bathwater were on the case. Although as far as what the markets think of this, as well as what's right in front of us today, none of this really compares to what's happening in the bond. Here's the thing. When the market falls, investors tend to rush into safe haven assets like US Treasuries because our government is seen as a very stable place to park extra money. Normally, the more investors buy in, the less Treasuries have to pay because there's so much demand for guaranteed returns. But this time, the opposite happened. The market crashed and Treasury yields went higher, suggesting that investors and countries weren't buying Treasuries anymore. They were, in fact, selling them. This resulted in interest rates going up during a time the market was going down, the exact opposite of what you would expect to happen historically. And as Deutsche Bank said, the damage has been done. The market is reassessing the structural attractiveness of the dollar as the world's global reserve currency and is undergoing a process of rapid de-dollarization. Or I guess in other words, for the first time in decades, investors were not only pulling their money out of the markets, but also out of the United States. And according to him, this is the most concerning piece since the tariffs began. It's showing a deterioration in confidence in the US's place in the world.